Market briefing. It's Thursday, October 13th, 2022. Hope you guys are doing well. Big day for economic data. Definitely the biggest day of the week as everyone is anticipating the release of CPI data, the main way we're tracking inflation right about now. We're going to get to that. We're going to come back. I thought it'd be good to open with where the markets are, a couple other stories, and we can kind of come back to that and see what's going on. So right now, S&P futures up 1.1%. Dow futures up a little bit more than 1% at 1.03. NASDAQ futures up a little bit less than 1%, up 0.91. The 10-year yield, for what it's worth, falling a little bit in conjunction with the rise in pre-market trading on equities. 10-year is at 3.849. So we're definitely going to digest some of this data as it comes through, and we'll see how the market responds. So remember those numbers, essentially major equity indexes up around 1%. We did get earnings from BlackRock, a little bit of a varied story there. The stock really crushed it, BlackRock did, as it related to earnings. The expectation was for the company to come in around the $7 billion in earnings. They actually came in about $2.5 billion above that number. So a very, very resounding beat on earnings. But right now, if you're BlackRock, the biggest thing that people is concerned about is your actual assets under management. This is the largest investment manager in the world. They own tons of mutual funds, tons of ETFs, tons of structured products, other things like that. And assets have fallen 16% year over year. So if you're thinking about that through Q3, you're probably not all that shocked given where the market is, but people are going to be really paying attention to those flows. When you wonder how they got that earnings beats, probably some of it is in controlling expenses, specifically on the marketing side, and some of it is just product mix. BlackRock offers products that charge just a couple basis points for management. If you have a pretty passively held S&P 500 ETF, for example, you might just be paying 2 or 3 basis points for that. But they also have active strategies. If you're in an active small cap international product, something like that, you're probably paying more. So there is quite a bit of nuance to their product mix. So that's probably where, if we dug into the data a little bit more, we would see some of the improvement relative to the expectations on earnings. And this is also an adjusted earnings number. So there were some one-time things that they wrote off. Interestingly, and maybe not all that surprisingly, but I think there's some good news and some bad news. Equity net flows, so how much money came into their equity products versus how much left their equity products, that was down $29 billion. And now that's not $29 billion of revenue. That's how much assets under management they had. So it was down about $29 billion. Fixed income flows were actually pretty strong. I was a little bit surprised by that. I mean, you would think if money is leaving one asset class, it's got to be going to another. But we really have not seen a whole lot of strength on the fixed income side in terms of pricing. But fixed income inflows were up about $90 billion. So that was relatively favorable. Retail investors were down about $5 billion as it relates to flows. So people leaving out. Exchange traded funds were up about 22 billion, and very, very decent numbers, but not great numbers, I would say, from the institutional side at $47 billion of positive net flows. So what this essentially tells us is money is leaving equities, at least in BlackRock's case. Some money is finding its way into fixed income. I don't think that's necessarily expected to be a one-to-one rebalancing or reallocation. In other words, if somebody took money out of equity, I don't necessarily expect that one person put the exact same amount of money back into fixed income. But fixed income is becoming more attractive. And so they did pick up some flows there. Retail investors getting skittish, institutional investors remaining, at least on a relative basis, a little bit more committed to staying into the market. I will say that institutional number, 47 billion of net flows, not necessarily staggering. So it's not a huge number, but it is a number that I think's worth noting, at least in comparison to what's going on the retail side. We do have a new vaccine. Tom Russell's not with us today. He participated in that trial, big vaccine guy. But Pfizer and BioNTech have rolled out a new booster. It's a new stage 2 and 3 clinical test. They say that the booster showed big increases in the antibodies specifically prepared to fight the BA4 and BA5. I guess we're on Omicron still. I don't know, whatever variant we're on right now, it did well on that. And so people are pretty positive about that. I mentioned earlier, market is essentially up about 1%. Pfizer was up significantly more, as was BioNTech. We are starting to see some movement in the market, and we'll come back to that momentarily. But I guess this is just kind of a weird thing to me that we're still talking about the vaccines when the biggest headline by far, it's odd to see a stock up 5% pre-market on vaccine noise on CPI day, but that's still where the market is. There's obviously still a decent cross-section of the population that is really paying attention to that. We are looking for initial jobless claims. So if you'll bear with me, sorry, we're flying solo here. And this is buried way deeply now. So U.S. weekly jobless claims. We were looking for a figure at about 225,000. The previous reading was 219,000. We came in a little bit warmer. We came in at 228,000. So a little bit warmer than the expectation, a little bit warmer than last week. So 9,000 more initial jobless claims than a week ago. As it relates to what the Fed is trying to accomplish and what they're wanting to do is break the economy, at least to a certain extent, with these interest rates, slow down demand. This is one data point that potentially maybe we should be looking at. But I would argue that by far and by a wide margin, the most important data we need to be looking at today is CPI. So giving you guys just kind of the lay of the land. On overall CPI, so just the CPI number, we were looking for a year-over-year change of 8.1. That would be slightly lower than what we saw last month when it came in at 8.3. On the core CPI number, we were looking for a figure of 6.5 on a year-over-year basis, which would be a slight increase relative to the 6.3 that we saw last month. So we came in hot. Not staggeringly hot, but a little bit hot. So core CPI, which I would argue is probably the single most important number that people should be looking at. They were looking for a month over month change of 0.6%, 0.4%. We came in at 0.6. As you know, if you compound monthly data, that's going to make your annual number higher. So we were looking for really something at that 6.5 range. We came in at 6.6%. So core CPI, as a reminder, it's going to strip out your energy costs as well as your food costs. Now, I feel like we could simplify that and just say we're stripping out our energy costs because food is energy when you think about it. Makes you think early in the morning right there. But we came in hot. So we came in at 6.6. The last reading was 6.3. The expectation was 6.5. It's a little bit rich. It's not necessarily staggering relative to what we knew yesterday already from the producer's price index, but a little bit of an uptick there. On the overall CPI, it really comes down to how you want to interpret this. The last reading was 8.3. The expectation was 8.1. And we really just split the middle there, right down the middle at 8.2. So if you wanted to view this as good news, hey, the yearly increase of CPI fell from 8.3 a month ago to 8.2. If you want to look at it maybe a little bit more pessimistically, hey, we thought we were going to come in the 8.1 range. We actually came in at 8.2. So a little bit higher than expected. You're going to have to bear with me a little bit. Futures do not appear to be updating on my computer. We're still on a little bit of a lag, but let's take a little pause and then we'll see if these, there we go. We got it. All right. So just a minute ago, S&P was up 1.11%. The S&P is now down 38 basis points. So we've seen a 1.5% move essentially on the CPI data. I don't think jobs data had anything to do with that. And already, just as I've said that, S&P futures have fallen another 50 basis points. So another 0.5%. NASDAQ futures are now down 2%. Previously, they were up 0.91%. We're seeing a harsh market reaction to this. And I think that it doesn't make you feel any better, but that's very much to be expected. On the rate side, we were looking at the US 10-year at about 3.85. We're at 3.97, almost 3.98 right now. So rates ticking up. All of this kind of is circular, and it goes back to so much what we talked about in the macro presentation on Tuesday, which should be up on the blog pretty soon if it's not already. There is a real credibility crisis for the Fed. They were slow to act. Their predictions have consistently been wrong. And what they are doing is one, hurting the market. It's hurting economic participants that own stocks, that own bonds. It's hurting folks like that. But it's also really not doing anything as it relates to impacting the economy the way they need it to be impacted. We're not seeing improvement, not measurably so, on the inflation picture. Even with rate hikes, even with double rate hikes, triple rate hikes, even with the expectation of more triple rate hikes, we're not really seeing that dent. I've said it time and time again in here. I'm still shocked that the employment picture is as clean as it is. I'm probably with most of our audience in that I don't totally trust every single data point that comes into employment, whether it's the JOLTS jobs opening report or the participation rate. I think some of that's massaged and some of it's a little bit funny money. But we're not really seeing much of a change there. I mean, when the expectation is for a very, very slight uptick in initial jobless claims in this environment, and that's pretty much what you get, give or take a rounding error, you're not really punishing the job market the way that would be expected with these rate hikes. You're also not doing anything on the inflation side. So much of this inflation problem is still very much supply side driven, which, if anything, interest rates continuing to rise could hurt supply side. If it costs more money to borrow money, to increase production, to alter, shift, change, improve your logistics chain and your supply chain, you may be less likely to do that. So I think we're in a really unique environment right now where we've kind of joked about the Fed pivoting and saying, hey, we're actually going to stop raising, or maybe we're even going to cut rates. I've got to be honest, and Ben's not here and Tom's not here. I'm sure those guys might disagree with me. I talked with Sam about it yesterday, and he looked at me like I was a crazy person. But I do wonder at some point, when will the Fed actually go into self-preservation mode? I mean, we've got higher inflation across in Europe. We've got a strong dollar. At some point, you do wonder, when do they say, hey, we've done this thing over and over and over, and all we've done is hurt stock prices, but we haven't impacted the employment picture and we haven't impacted inflation. I mean, the reality is, if they keep doing it, at some point, investors are going to lose enough money that they stop buying stuff. So you're going to hurt demand that way, but that's not necessarily the intention. So they need rate stability, even on, the 10-year, just in such a brief period, seeing the moves that we're seeing. It's pretty staggering. I think the market's responding the way the market should be responding to this. If the Fed says we are going to raise interest rates to stop inflation, and inflation is not stopped, you have to work on the assumption that they're going to continue to raise interest rates to stop inflation. When they raise interest rates, it hurts your earnings potential. It hurts your ability to return capital to investors and to shareholders. So the futures reaction is actually kind of in line with what I expected. There was an interesting piece the other day. I want to say it was either Morgan Stanley or Goldman Sachs saying that if we came in roughly at this range, in line with expectation, which we were actually a little bit worse. They said if we came in line with expectation, they thought the market would be down 2%. Very much lends itself to the good news is bad news type environment that we're in which you have to almost think through the second derivative. Hey, this went how we thought it would, but stocks are still down. We didn't make enough progress. They speculated that if the number was significantly better than expected, meaning the CPI data came in lower, that we could be up 2% in trading on Thursday. They said if we missed, we'd be down 5%. So if you're looking for good news today, futures aren't down 5%. So that ought to make you feel a little better. But we've seen a huge reversal. Dow futures down from when we started this call 15 minutes ago. Dow futures are now down 243 basis points. S&P futures are now down 290 basis points. NASDAQ futures down about 290 as well. So those more growth-oriented companies are definitely taking it on the chin in pre-market trading. To be honest with you, the first clue on this, the overall futures market was not showing data, but earlier today, I looked at Pfizer and it was up about 5%. When I just went to do a spot check on it, it was flat. And so even with the good news of the vaccine, the CPI story is really dominating the headlines. It's a crazy market environment. It's a challenge. I think we've got to just buckle in and focus on what we can control, which is really portfolio positioning and staying disciplined to targets. But it's going to be a choppy day. The data is not the worst data in the world. I think, honestly, if we'd gotten this data earlier in the year, it might have been perceived somewhat favorably. If you said, hey, We went from 8.3 year over year inflation to 8.2. There was a period in time in which that might have been viewed positively. But this is just further proof that even if we were expecting modest improvement from 8.3 on CPI to 8.1, even with the rate hikes, even with all of the attention that's being paid to inflation, we weren't able to actually hit that target, which again was a target for very, very modest improvement. I think the Fed's got to wait. Part of their formula is probably going to be waiting for these really high inflation comps where they hope that things get better. Right now, there's not necessarily anything in the report that would suggest to me that that's absolutely going to happen. I mean, the fact that when you strip out food and energy, you still ran hotter than expected, that speaks, I think, to the everyday challenge on the household level. We'll wrap it up there. We'll be back tomorrow morning. Hope you guys have a great day, and we'll get to work. We'll try to lift this market up one trade at a time. Hope you all have a good day.